Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I am your host today, Alex Saunders, Head of Quant Macro Research, and I'm joined by Adam Pickett, our Head of Global Macro Strategy. Welcome to the show, Adam.
Thanks, Alex. It's great to be here with you.
We are recording this podcast at 10 a.m. on Monday, June 1st, 2026. There's a lot to discuss, as always, and as has been the case in the last few months, not least in the Middle East, where at least the contours of a deal looked to be taking shape. Conditional on a deal, and the uncertainty remains high. There's been less encouraging news flow really coming out in the last few hours. But conditional on a deal, that would be a relief for fixed income. We studied oil price peaks, and we found that inflation comes off fast at the headline level and more slowly on core. But rates unwind most of that move higher.
Interesting, Alex. And then I suppose one of the questions we often get asked is, how do we differentiate between countries? Because obviously some places have, inflation above target, some places are closer to inflation below target. Is there any way to differentiate the rates response function to the post-oil peak phase after that happens?
It's an important question, actually, Adam, and we sort of think about it. We differentiate on two axes, if you will, right? Number one is, as you say, the country in question and whether inflation's above or below target. And then the second sort of vector of to study really is the size of the oil price sell-off. And if we look at our commodity team's latest views, that would be in the small, sort of less than 20%, between 10 and 20% sort of potential sell-off. Those small sell-offs tend to favor countries with below target inflation. So rates rally there, whereas the above target countries, you'll typically see a sell-off. However, it's somewhat interesting that reverses slightly when you see these larger 20% plus sell-offs. In that environment, or in those instances, we see rates rally across the board, and actually the above target ones rally, but they rally only slightly more than the below target. So from our perspective, that leaves us with a bias really for countries where inflation is below target on the rates side. Now, for the dollar, Adam, what's the view there?
Thanks, Alex. Somewhat, similar to the study that you outlined, where the data backs up the sort of market intuition that you kind of want to receive the places with lower inflation than higher inflation in the event of the oil shock diminishing. I think in the US, given it looks like more of the rates repricing there has been domestically driven by sort of reappraisal of the labor market situation. The rates factor in our Eureka Quant Eurodollar model will probably stay in the sort of bullish dollar camp. And as a reminder, that's just 2-year rate differentials detrended versus the 55-day. And so I think in a resolution scenario, you'll probably unwind more ECB hikes than the Fed. For relative equities, as we've described before, the AI thematic looks very resilient and quite long lasting. And so I don't think the Iran situation will dramatically change what is already a relative equity factor pointing in favor of dollars. And lastly, on data momentum, looking at the Citi data momentum indices, again, the US versus Europe gap is already so large that even a few surveys looking better in Europe after an Iran deal probably won't be enough to turn around that ship. The terms of trade factor, interestingly, is already in favor of euro over dollars, and that will naturally continue to push that way if oil does fall further. But what I'm trying to get at is, from a quant perspective, it looks like there's a decent risk that 3 out of 4 of our dollar signals are likely to stay pro-dollar into the summer. And so our perspective is if you get a knee-jerk dollar sell-off on an Iran resolution, ultimately that could be a dip in the dollar to buy.
Thanks, Adam. And then the other major asset class to cover would be equities. We looked at it from a positioning lens, and our equity quants have a high frequency model. A couple of interesting points that came out of that. More recently has been a move towards AI positioning. So that's markets in emerging Asia, and the NASDAQ, for example, in the US became more popular. The NASDAQ in particular moved from having a short position to a long position. We did not see a bounce back as strongly or at all really in some of the European markets. The other point to make, there have been some worries and some client questions around the narrowness of recent performance. We've studied that and the strong price momentum. We've studied that, and we don't think that's a problem in and of itself. The concern in terms of market worries that we found was more in large changes in term premium or large sell-offs in rates as being, and it's the change, not the level, that's important, as being much more of a limiting factor, I think, for equities. But overall, a deal would obviously be fixed income positive and probably equity positive as well. Below target inflation countries give you less of a sort of scenario risk in terms of potential positions. And I did want to flag one other indicator that we use very tactically on the equity side, which is our markets team's polls indicator, which is flagging, at least in the near term, a little bit of exuberance, right, and would suggest some tactical caution on equities, particularly if we do get a deal and a bounce in equity markets. So with that, thanks for joining us today. This episode was recorded on June 1st, 2026. I'm your host, Alex Saunders, with Adam Pickett, our head of global macro strategy. For more details, Citi clients can check out our report on the Citi Velocity portal. Next week's Research at Citi Markets edition will be hosted by Scott Cronut, Citi's head of US equity strategy. And be sure to watch for our Research at Citi podcasts, which you can view on this same channel. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup, Inc. or its affiliates and are used and registered throughout the world.